afternoon, Sherry, and welcome to our presentation. Thank you very much. We're very excited to work with you on this client, Barclay, and his business, the Global Wireless Tracking Solutions. So, as per your request, today we have presented to you a presentation that encompasses all the different aspects that you asked us to look at about Barclay and his business. And our main goal today is to increase the efficiency of the taxes, just to reduce the amount of taxes that Barclay has to pay on his businesses, reduce the amount of tax liability, and take advantage of all the tax credits that he can with his business. So with that said, that is the goal of our business, or that is the goal of our presentation. And with me here today are my colleagues Andrew and Nikki, and we will follow this agenda for today. So Nikki will start off by presenting about our findings as well as our analysis and solutions for Barclay's current company structure and its tax inefficiencies and how that can be improved. Then Andrew will take on the part about Barclay's proposed business structure for future expansion. And I will then take the presentation back and talk about the other considerations regarding Barclay, his personal life, and perhaps some future planning, and then go over an implementation plan for Barclay with our solutions. We're very excited about Barclay's business, as it is currently a business that is growing, and it looks to have a very, very bright future. So now I will pass that on to Nikki.
So I will start off by just talking about the current situation, the current structure of the company, as well as what tax implications those have. So this is the current company structure. There's a GWTS at the top with WT Devices, a profitable company, and WT Solutions, a company that has been incurring substantial losses over the past couple of years. So the main problem with this structure is that while one company is profitable, another one is making losses, they can't get together, and we can't apply those losses with the current structure to the more profitable company and against that income. Our main solution is to amalgamate the company. However, before that, we need to consider what types of losses can be applied to what company and what are the conditions for that. So criteria for applying business losses, it needs to include same or similar business, which in this case is true. Both WT Devices and WT Solutions both operate in the business operations industry. They both work with GPS systems and consult and analyze the data how to plan trips better. There needs to be a reasonable expectation of profit. So there is profit potential with new programs, and especially with our amalgamation strategy, the two companies can work quite well together. And there's only a 3-year carryback period, so this really needs to be, we need to keep this in mind so that we can carry it back first, and it can be applied to certain profits that have incurred previously. So as I mentioned before, our main proposal is an amalgamation or wind-up. So before we go into our selection, I would just like to talk about some similarities and differences between the two. So with an amalgamation or wind-up, the assets and liabilities are transferred at cost. There is no capital gain triggered with the transfer. And the RDTOH and CPA accounts, they're all carried over to the new company. The assets are put together in one bucket and valued in the same account together, as well as RDTOH and CPA accounts, as I mentioned. Some differences are, in amalgamation, the losses can be applied in the first year. Well, with the wind-up, you do have to wait a period of 1 year before you can do that. So our recommendation is to perform an amalgamation for immediate results and immediate tax refund. So just to illustrate how we propose to implement this amalgamation, we're assuming that there is 1,000 shares per company for WT Devices and for WT Solutions. So we will take 1,000 shares from WT Devices and 1,000 shares from WT Solutions and create a new that will consist of 2,000 shares. So the losses from the WT solution can be used to offset any profits for up to 3 years previous that WT device is made, and any unused ones can be applied, carried forward indefinitely. There are certain tax implications with regards to amalgamation. So again, just to summarize what we talked about, business losses can be carried back 3 years. We then suggest, once this has been done and the amalgamation has been finalized, you refile your tax return so that the losses can be applied. You will receive a maximum tax refund of $500,000, and you will reinvest the money in the holdings company of GWTS. Another implication of the two companies working separately was the fact that employees that were working for WT devices were also working for WT solutions. But the expenses and their services were not applied respectively. So now, as a result of the amalgamation, all employees will be working for the same company, and we don't need to worry about who are they billing and how much are they billing for each company, because it's all one. And the employment expenses will be deducted from the one new company that we've created. Great. Finally, I would just like to talk about some other current compliance considerations when it comes to tax. So WT devices and WT solutions are both financed through non-interest-bearing intercompany loans. So interest should be paid on the loan to GWTS, and the paid interest should be deducted from the business income. So this can be done with the amalgamated and the newly merged company as well. So over here, I'd just like to show you just the amounts of the loans. We've assumed a 2% annual interest rate. And while there are some tax savings by applying this expense and of $10,000, there still is the fact that they have to pay the interest. However, this is something you have to do, and it's not so bad considering that there is a tax benefit to this as well. Another one is the fact that the assets in the merged company are now will be put together. However, they are still reported at a lower book value than at their fair market value. So because of this, the CCA claimed is much lower, and the taxes payable are higher because you're deducting less from your income. We've come to the conclusion that it's best to just leave it as it is, although that was a consideration to perhaps transfer the amounts to fair market value. There are substantial differences between the book and fair market value, particularly when it comes to the intangible assets, and very large capital gains will be triggered with this. We are here to help this company make smart tax decisions and to go forward with a strategy that will, at the moment, yield really great capital gains is not something that is wise. So we just recommend to maintain those current values to avoid this tax. And now Andrew will talk about the proposed company structure and the tax implications of it.
So Sherry, moving on, Mr. Cummings was interested in a couple of business opportunities and now we'll get into that. Right, so Mr. Cummings was interested in pursuing Banco SA, and we will take a look at that first, while the other option was to have a partnership between Zombie and Solutions. So firstly, again, sorry, those are two options there, and we will find some tax advantages because perhaps implement. So we obviously don't want to interfere with his business decisions. We believe that his business decisions are to the benefit of this company. All we want to do is just look at the tax implications and see if we can help them with that aspect. So firstly, when we look at purchasing a new company, we want to weigh our options, and two options would be whether to purchase the shares of the company or to purchase the assets. We will look at the key differences. So starting with the shares, we you purchase all the shares, you have control of the entire company, which means you have all the share capital, you have all the liabilities, and all the assets as well. With assets, just purchasing assets, you have to choose the only assets that you want, and that way you won't have to incur any liabilities as well. As well as if you purchase shares, you acquire all the assets at its cost. This way, it's not as advantageous as the assets if they have a higher fair market value than their current cost, therefore we can't deduct a higher CCA. So typically, when we purchase a company, the asset yield is more favorable because of the higher CCA rates if there is a higher fair market value of assets available. And also you get to pick and choose the assets you want. However, in this case, we do suggest that we purchase the shares, main reason being that there is a lower corporate tax rate of 5% in Mexico. If we keep the company there and we pay taxes in that jurisdiction, then we have greater after-tax proceeds to reinvest in the company and perhaps improve on quality controls and also inefficiencies with that company. Other considerations would be, we don't know whether the assets in Banco are, if there's a difference between the fair market value and the costs. Perhaps the fair market value is even less than the costs, and that would be a risk to the assets. Next, we will look at the partnership with Sauder. During initial talks, Mr. Cummings was introduced with the idea of having a partnership between WPS and his company Solutions. However, since we did implement an evaluation, this kind of makes things a bit more tricky. So, assuming that Zombie is still fine with this proposal, we believe that if they still want to invest the $1.5 million, they'll have a 30% interest in the new operating company. So let's take a look at the tax implications of that. The key thing to focus in on is the cost base. There's a very low cost base, and that will produce a very high capital gain. However, in Canada, capital gains are only taxed 50%. Our taxable capital gain is roughly $750,000. And with corporations, when they receive capital gains, it's considered interest income. So it's a different tax rate than the corporate tax rate, and it's at approximately 45%. So therefore, they have roughly $377,000 in taxes payable. Our recommendation would be to issue a dividend to our holding company, Mr. Cummings' holding company of GW. And this way we'll get a refund of 26.67%, significantly lowering our taxes payable, his taxes payable. And the total proceeds less the net taxes would be roughly $1.36 million. That would be the dividend going toward GW company. And just lastly, because there was a capital gain, there will also be an increase in the CDA balance, the capital dividend account. The other half of the taxable gain is, the other half of the capital gain is included in this balance. Why this is significant is because the capital dividends are non-taxable to the shareholder, and this way we can also increase further proceeds towards the holding company GW. Perfect. So to talk about some of the tax credits, I'll have that.
So a big reason why WT Devices is successful is because it knows how to operate very well and very effectively. However, WT Solutions has an even greater potential to generate profit and an even greater potential to do well. However, it needs some capital and it needs some investment, especially in its research and development department. So one way that we can do this is through profits, especially through the valuation. We can increase the sum of the profits that the company are all owning, or through Canadian tax credits such as SHRED. So it is available to Canadian companies performing research and development. And it's a 30% cash refund on any expenses, including tangible assets that you may use to conduct your research. So we propose to make use of this and to consult Mr. Cummings of this tax credit and to use the cash refund to reinvest in the business for future growth. So this not only decreases, in a way, the expense that you're putting into your research and development, but it also gives you that cash refund that you can then reinvest again into the business.
So now I will take over and we will look at some of the other considerations with Mr. Cummings and his company. So the first thing we're going to look at is funding for Mr. Cummings' vacation property. So he was looking into buying a vacation house elsewhere, and the total amount he would need would be $1 million. So here we have a decision matrix where we've evaluated the different options that Mr. Cummings could take. So he could issue an annual bonus, a shareholder loan, pay back a loan, or declare dividends on his shares. So this is all ways that Mr. Cummings can potentially get money from his company. And up there we have, which option will give him $1 million in cash, and which option will give him the lowest tax implications, because that essentially is the most important part. So here the green represents, of course, the better options. So investigating the different options, issuing the shareholder loan or paying back a loan would be the most beneficial ways to fund for Mr. Cummings' vacation property. So we do propose that he issue a shareholder loan through his company to fund for his $1 million vacation home. And the second item that you asked us to consider, so I apologize for the title. We are actually looking at Mr. Cummings and the potential sale of his business in the future. So one of the things he was looking at was, okay, so 5 to 10 years from now, I'm going to have this really great profitable business and I would like to sell it. So he wanted to see what can he do now to decrease the amount of taxes that he may have to pay for the future, since he is going through a lot of corporate restructuring right now. So what we've investigated to be the best option for Mr. Cummings is, because he does have a wife and potentially in 5 or 10 years they might have children. So we propose that in the future, say they have children, the best way to go about this is to set up a trust and do an estate freeze on his assets in his company. And then he can then pass down this company to his children and essentially reduce the taxes payable on his business when he decides to sell. So lastly, we're going to talk about some implementation. So here we have prepared for you an implementation plan about how we see Mr. Cummings' business kind of going through this corporate restructuring. So in the first month to 6 months, we see the amalgamation taking way, and then resubmit his tax returns due to the amalgamation in also the first month. Then this third month to purchase Blanco, as we mentioned, through purchasing the shareholders to issue shares. And also lastly, so a year from now, to then continue the partnership, go ahead with the partnership with Zombie, because we're first going to form the amalgamation, and then with that company, go ahead with the partnership. So today we covered the current company tax inefficiencies. To improve the efficiency, we propose to amalgamate. In order to reduce the inefficiency in the newly proposed corporate structure, to purchase shares of Blanco and to proceed with the Zombie partnership after the amalgamation. And lastly, for other considerations that we talked about, to set up a trust and an estate freeze in the future when he has children for his company, and also to issue a shareholder's loan for his vacation home. So that summarizes our solutions for Mr. Cummings and his business, and we hope that you can propose to us any suggestions that you may have on where to work with this client. Thank you very much. We'd now like to take any questions.
I was just looking at your solution made of $1 million to you suggest that we should have a new shareholders one rather than the routine of the existing shareholders. Is there a reason why we get one or the other?
It can be either of the two, so they're both in green. They both have low tax implications, and you receive $1 million for those. It really just depends on what Mr. Cummings would like. So, with regards to shareholders loan, if it's repaid within 1 year of the year after the company's was issued, then it doesn't have any tax implications. It's not added to the project. There's no interest that needs to be added. He did issue a $2,000 loan to the company, so the company can just repay him for that as well, whatever he would.
Just you can also receive funds by having a dividend towards have a dividend from the amalgamated company towards both company, and then one company can then pay off Mr. Cummings. Because dividends from between subsidiaries and CCPCs are on that.
One of the things he's doing is continue buying this Mexican company to do with GWS. In order to do that, he's proposed to go over and borrow from the bank. And so what's going to happen in this situation with the bank loan with interest expense and GWS? Is there any ways or sort of how to use that interest expense?
Well, that interest expense would be possible to the income generated within the holding company. So that would be the very efficient way to pay expense.
And so, is there any funds in GWS?
If there are dividends issued to GWS, then that can be also.
I have a question regarding the nomination. I didn't understand. You're proposing evaluating the UBC and the influence of the company compared to the Are you proposing incorporating amalgamating with GWS or just amalgamating them?
So it would be the new company and then
Concerns with having zombies allocated 30% ownership in both of the operations. Initially, it looked like it was going to kind of now that we're actually participating in the process.
I'm assuming Mr. Cummings believes that zombie would be a beneficial part of the accounting business. I'm assuming they have very knowledgeable staff there. All their suggestions would be for the benefit of the company. So with 30% stake in the company, we still have ownership and control of the company. So I think assuming that Mr. Cummings does believe in the value of this partnership, it's still good. No, because it's a dividend to because the amalgamated company is a subsidiary of the holding company, and as a CCPC, there will be no taxes payable for it. It's just
One of the solutions also was suggested was to charge interest on income loans, so that the information that the subsidiaries did an analysis to show the benefit of charging interest. What happens with that interest account?
Great. So now with our recommendation, both companies will have to pay interest for that extra expense. However, it is deductible, so you receive that 25% tax savings on it. It'll help offset, their payments to GWTS for the maintenance, because overall net you're still their time.